Okay, well, good afternoon, everybody. Again, this is Tim Hilligus from Clayton McCurvey. Want to say welcome to our fifth installment of the Payroll Protection Program loan. We started back thinking about this the end of March 27th, when the president signed the CARES Act, kind of worked our way through all the derivations of the law. The second phase of, or 3.5 phase of the stimulus package, which put the second tranche of funds in there. And we've also been dealing with the consistent updates from frequently asked questions to the interim final rules. Throughout the years, I've spoken many times at a lot of the colleges locally, and one thing that this has certainly proven is when you're in the tax and accounting realm, your job changes almost every day, and that's certainly true with this. We're on the interim final rule 15, and we've got frequently asked question 48, at least through the start of this webinar. Who knows, by the end of the webinar, maybe we'll have more. For those of you who are not familiar with our format, we're basically the three of us, Sarah Russell, one of the tax partners from my firm, Ben Smith, one of our senior managers, and Ben's really key to some of the technology that our clients have been using to gather this information. And myself, I consider myself just strictly the MC, jack of all trades, master of none. Rob Dukowitz, one of our partners, would say I'm a mile wide and an inch deep. To kind of clarify my knowledge. But in this case, Sarah and I have worked pretty closely trying to stay in touch every day with some of the key issues that our clients are facing. For those of you who are not familiar with our firm, we work with closely held businesses. So all entrepreneurs, every one of our clients that Sarah, Ben, myself, our other 8 partners work on, this is probably the most important thing that's impacted their business. And we were talking earlier, the stimulus that's been created here, both for individuals and for businesses, probably the most impactful stimulus where we've seen direct connection to businesses in my entire career. And I'm going to suspect I haven't talked to many people older than me, that perhaps in their careers as well. So what we're seeing here, I think, is unprecedented, and we're trying to stay on top of it. A couple housekeeping matters. We will end right at 4 o'clock. We may not get to all of your questions while we're having our presentation from Sarah and Ben. We'll do our best. Typically, we stick around for about an hour and answer those questions. And both the questions and the presentation will be posted online, and you'll be able to have access to that. What we're asking, for those of you who were here 5 weeks ago, we had asked you to save the date on Wednesdays at 3 o'clock and thought we'd be able to get through this through the end of May, but considering our most recent rules, our IFR, latest IFR came out on May 22nd. And now, for those of you who've been following some of the news, there's a chance we may see some substantial changes to the criteria for forgiveness or the timeline for forgiveness. So we're anticipating we may be doing these a little bit longer. So what we'd like to do is ask you to save, at least for the next 2 Wednesdays at 3 o'clock, Sarah, Ben, and myself will be planning to present any changes or any clarifications that come through, so that when that time comes, whether we end up with an 8-week period or longer, when the time comes for you to determine your forgiveness, you're in the best position you possibly can be with the information that we have available. We do take questions live. So those of you who are able to ask questions, you'll see that there should be an icon on your screen. And I'm going to take a quick look right now, because we already have looks like maybe about 10 questions already. And the other key thing that's great about the program we're using, you'll see there's a little arrow next to every question. So if there's a question that's critical to you or specific to your circumstance, if you click on that up arrow, that triangle, it'll help rank those. And so we'll be able to go ahead and they call it upvoting. So you'll be able to upvote a question, and it'll more likely bring it to mine and Ben's attention while Sarah's presenting, or mine and Sarah's attention while Ben is presenting. So please definitely go ahead and ask questions, and try to use that arrow as your key for letting us know what's important to you. Let me take a quick look at my notes and see if there's anything I'm forgetting. Let's see here. No, I think I pretty much covered everything. So I'm going to turn it over to Sarah, and Sarah's going to go ahead and take away from where we're at on the latest on the payroll protection program loan.
All right, Tim. We're going to switch things up a little bit today. I'm not going to talk the entire time. I'm actually going to give Ben a chance to talk today. After I go over some of the new updates, I'm going to let him talk and go through the loan forgiveness template that we talked about presenting to you today. So today we'll talk about some proposed guidance that's out there that we're expecting hopefully will be passed by Congress in the next pretty soon, maybe tomorrow, maybe as early as tomorrow. We will talk about the new guidance that we got right before Labor Day weekend started, and then I'm going to let Ben go ahead and go through some of the more detailed calculations. Last week we said we may not have a PowerPoint, we may just be presenting some Excel schedules. Ben is going to be the one who goes through that tool for you. So if we just take a look and reflect back on where we are, and I apologize, this slide should be updated. It should say through May 23rd, 2020. This is where we're at today, or as of the 23rd. This has gone down compared to when we presented last week by about $2 billion. And this really reflects the companies that on the 18th sort of followed that safe harbor that was out there and gave back the money that they decided that they were not eligible to receive. So still a little bit over $120 billion available in the program as of today. So if we talk about some proposed legislation, some pretty big news came out last week. We issued a blog on it, and the bill was re-proposed in the House yesterday. I think that they're going to vote on it tomorrow is what I'm hearing. And the Senate has tentative pro forma session scheduled for tomorrow. Possibly we could get this bill passed tomorrow if there's no objections out of the Senate. If there are objections out of the Senate, it probably won't be passed until sometime next week when the Senate is back in session. They left on the 21st, I think, and aren't due back until June 1st. So if they can't get it passed without objections, we won't hear anything until next week sometime. But pretty big news that will really impact some of these calculations that we're talking about. It's called the Paycheck Protection Program Flexibility Act. And as the bill stands today, it would extend the covered period from 8 weeks to 24 weeks after the origination date, or December 31st, 2020, whichever is earlier. So if you got into the program late and you had 24 weeks, would go past that December 31st, 2020 deadline, you would only get until December 31st, 2020 to spend the money. It includes no limitations on the amount of non-payroll costs. So if we remember back on the very first interim rule that was issued for this program, they put a limitation, Treasury and the administrator put a limitation and said at least 75% of the forgiveness amount had to be related to payroll. This legislation retracts that guidance and says there will be no limitations on the amount of non-payroll costs eligible for forgiveness. It also amends the terms of the loan to be a minimum of 5 years. And this is sort of retracts back that the 2-year maturity that was imposed by the administrator. For those of you that already have loans out there, which I assume is most of our audience, this will require some amendments to the loan documents you already have. But some good news there. You'll get a little bit longer time to pay off any amount that's not forgiven. It also includes an exemption related to the FTE reduction rule. If we remember, when we look at forgiveness, if you have reduced your full-time equivalents and you haven't rehired people back by the end of June, your loan forgiveness will be reduced by the same percentage. This legislation includes an exemption that allows a business, if they are able to demonstrate an inability to return to the same level of business activity, they are exempt from having to reduce their loan forgiveness. I don't know exactly what they will require to demonstrate that, but I found that particular clause in this legislation to be pretty beneficial to some companies that are sort of really If we think about companies that are in marketing or hosting live events, it's probably going to take them a while to sort of ramp back up to what the new normal is going to be. So this will be a favorable clause in the legislation for those companies. And then the other thing that is in this legislation is it allows loan recipients to benefit from payroll tax deferment, which was included in the CARES Act, even if the loan was forgiven. So right now, anybody who has a PPP loan can benefit from payroll tax deferment. And we've covered this probably in the very first or second PPP webinar that we had, but you can defer payroll tax payment for up to 2 years. 50% is due December 31st, 2021, and the other 50% is due December 31st, 2022. And that deferment was allowed for PPP recipients up until the date they received forgiveness of the loan. And this legislation allows that deferment regardless of whether or not you get the loan forgiven. So pretty much everybody will be able to take advantage of that payroll tax deferment if this legislation gets enacted. I will say that the Senate, before they left for recess, had a similar proposed legislation on their floor. There were a few differences in that legislation. It extended the covered period only to 16 weeks instead of 24 weeks. But most of these other items were included in that legislation as well. The other item in the Senate bill included qualified costs, would include the costs incurred for PPE or investments that you might need to make to your business to sort of meet the health and safety standards as everybody gets back to work. So I think that there's a pretty good chance. I told Tim today, I'm about at 98% that something's going to get passed, that the covered period will get extended, that this limitation for non-payroll costs will get lifted. To my disappointment, what's not in either one of these acts is there's nothing in there about the deductibility of expenses that for your loans that are forgiven, which we talked about in prior webinars. So I will say, the nerd in me did reach out to my representative and my congressman and ask them to insert that into the bill, but it's not in there as it stands today, and I'm not sure that any amendments are forthcoming. So pretty big news. If this gets passed, which I expect it will in some form, will change a lot of the hypothetical questions that we're getting. Can I do this? How, strategizing, how can you spend the money to get the maximum amount of forgiveness? A lot of those questions that we've been dealing with, maybe not so important because the timeline of which you get to spend the money gets extended so far that you should have no problem spending the money to maximize your forgiveness and potentially get 100% forgiven if you don't meet some of these other reduction rules with regards to compensation, FTE numbers that we've previously talked about. Interestingly enough as well, they did include in the legislation that we do have some companies that have no problem spending the money in their 8-week time frame. And Tim and I were sort of questioning, hey, is this going to prevent them, is this going to extend the time from which they could apply for forgiveness if this bill gets passed? And there was a clause in the legislation that said the borrower could elect to use the original covered period, the 8-week covered period, so it wouldn't extend the timeline in which they could apply for forgiveness. They would be able to apply for forgiveness once their 8-week period is up. So we'll keep you posted as soon as this bill passes. You should expect a blog from us to come out, let you guys know, and then we'll certainly cover it in future webinars.
Yeah, ideally, Sarah, I want to make sure people know when we talk about this, we're not thinking necessarily, we're not in the rooms with our legislatures, but ideally, we would like for our clients to be able to apply for forgiveness as soon as they felt they've met the maximum forgiveness allowed. There would be, it would seem like it would be an anxiety or an uncertainty to push them to a 16-week or longer period for forgiveness when they may know, like you said, in some of our clients' cases at the 8-week mark, that they'll be eligible for full forgiveness because of their specific circumstances. So I want to make sure people know that.
Yeah, I have a lot of questions on it and how it will work. if we look at it today, right, we have clients that are saying, okay, well, we think once the economy opens back up, we'll be back in business, and so we'll be able to rehire everybody if there've been what they think are going to be temporary layoffs. This extended covered period, though, certainly extends that timeline. Whereas right now you're dealing with a June 30th cutoff, and if you come into the third quarter and things haven't rebounded like you think they would, you know, are you going to be harmed if you have to have subsequent layoffs after June 30th and you have not elected the original 8-week covered period? There will be a lot more questions that will come out once this legislation gets passed as to how this will affect everybody. But it's important for those companies that haven't rehired their people yet, haven't been able to spend the money, to know that you will in fact probably get an extension of time to spend the money, and then you can make decisions based on what's best for you at that time. That makes sense. So we start talking about the new guidance that is out there. On Friday, late Friday, you know, I checked right before I logged off around 5:30 Friday, and there was nothing new out there. So sometime late Friday night, they did issue some interim final rules related to loan forgiveness. They also issued final rules related to the process. There wasn't anything real impactful in the process. A lot of it's related to lenders and what the lenders are required to do. So we're just really going to talk about the interim final rule on loan forgiveness and really only focus on a couple of items that have been clarified. I'm not going to spend time on the items that we still have questions on today. If I don't mention that we received some clarification, it's because we didn't, and the questions that we talked about last week are still outstanding. I want to make sure that we give Ben enough time to go over the tool. And so for those purposes, I'm just going to sort of highlight some of the items that we believe were clarified in this interim final rule on loan forgiveness. It certainly makes the guidance that was provided in the loan application, it's now legislation, it's now a legislative law. So we can be assured that whatever is in that loan application is what they're considering to be law, and there should be no changes, although we do expect some clarifications. It did clarify that bonuses and hazard pay can be included. It's just remembering that it's subject to that annualized $100,000 limitation. No employee for compensation purposes will get more than $15,385 towards loan forgiveness. So if you're paying hazard pay or bonuses and those employees exceed that $15,385 limit, you'll be limited to that number. It did clarify that self-employed individuals are capped at $15,385 or 8/52 of 2019 net profit, whichever is less. And that applies to Schedule C and general partners. And both Schedule C and general partners, it is clear that that is the maximum amount they get, that they don't also get employer health insurance premiums or employer retirement contributions. And the reasoning in the legislation is because those amounts are deducted separately on the 1040s for those individuals. There was no clarification given on the, we talked last week about the $100,000 annualized for one single pay period. You may have the ability to throw additional employees out when you're looking at, did I have a compensation reduction? They didn't give any additional clarification on that issue. So that's still one of those hanging out there. And there was no discussion regarding how 2019 bonuses paid out in Q1 2020 would impact that reference period, which is that January 1st, 2020 to March 31st, 2020 reference period. That has not been addressed. So we do still have those big questions that are sitting out there.
Hey, Sarah, let me just pop in real quick on a couple of comments that
Sure.
I think, and I want to kind of, I'm typically not a guy that does CYA stuff, but most of our answers that Sarah and I and Ben will talk about are really related to businesses. And there are clients which are typically S Corps C corporations. And yes, of course, we do have partnerships and we do have sole proprietors or Schedule C filers. For the most part, for our corporate clients, those are the rules are pretty consistent. But one of the things I want to make sure of when people are throwing the hypothetical questions at us about, is my cell phone deductible? Well, there is a unique twist for self-employeds, and that is, if you didn't take those deductions on your 2019 return, you all of a sudden can't have created them on your 2020 forgiveness application. So, if you're not taking telephone deduction, you're not taking utilities in 2019, they are not going to be allowed to be a part of your forgiveness calculation in expenses you incur in your covered period in 2020. So when we talk in general about, hey, are cell phones or our phone items considered utilities, the answer is yes. And so when we say, if you calculate that in that 8-week period, that they are a part of your forgiveness application, the answer is yes. But there may be a trump card for Schedule C filers that might limit your ability to do that. So I just want to make sure, because I'm scanning through all the questions and that theme of uncertainty about certain items, and I wanted to make sure people knew Schedule C filers, self-employed individuals, have some special rules, okay?
What else was included in the interim final rule? It addressed non-payroll costs as well. It did specifically state that their prepayments of mortgage interest is not allowed, but it did give some flexibility on rent and utility payments. And essentially what it says, it gave an example that said, a borrower covered whose covered period begins June 1st and ends July 26th. And they, in that covered period, pay May and June electricity bills. So potentially the May electricity bill is late, or at least we know that the May electricity bill was incurred before the covered period. But this interim final rule specifically said, the borrower would get to include the May payment and the June payment. And it would also get to include, in this example, the July bill was due on August 10th. It would also get to include the July amount that was related to the period before July 26th, for that covered period that it was. So it certainly allowed paid and incurred for these utility payments. So we thought that that was pretty interesting, that there was no clawback of that May payment that was probably paid June 10th, even though that electricity was incurred prior to the covered period. So while it gave you some flexibility, you do have to remember that currently, as the law is written, although we believe it will change, you would still be limited to that 25% can be on non-payroll costs. If they lift that rule, which is expected, this really opens up some additional costs to be included without limitation, which I think really benefits the restaurant industry, the hotel industry, those industries that have high rent costs, and utility costs. Those will really be impacted by this flexibility that they've written into this interim final rule. That being said, could they change this rule to account for this new legislation that's coming out? They certainly could, and put a limit on it and say it's only going to be 2 months worth, but sort of TBD on that. We'll see where that goes. The other thing that's in here, they talked a little bit about the loan forgiveness reduction, and sort of reconfirmed if rehires happen during the covered period. So this would be during your 8-week period, not as of June 30th. The layoffs are considered terminated and your loan forgiveness is not impacted. So I think this is a good rule. It sort of clarified some things for me, because I wasn't certain, right? If during the covered period I had hired back all of my employees, but my covered period ended on June 5th, do I have to maintain those employees through June 30th? To me, the interim rule sort of indicates that, hey, as long as during your covered period you rehired those employees, then your loan forgiveness would not be impacted. We still have not heard anything related to a requirement that you have to keep those employees on after the covered period, or if you use June 30th as your safe harbor after that June 30th deadline. Surprisingly, that's still not, there's been nothing issued on that specific legislation. The other good thing that was included in the rule is it specifically indicates that a double penalty won't apply. So a lot of people were concerned, if I have an FTE reduction, right? So say I cut the hours of my employees and everybody was only working 50% of the hours they previously were at. So my FTE, I would go from 1 to 0.5, but their salary would also be reduced because they're only getting paid for, say, 20 hours a week instead of 40 hours a week. And so there was some concern that there would be a double penalty. They would get the reduced FTE and then also that reduced salary. And the interim final rule specifically said that double penalty will not apply. In those instances, the FTE reduction would apply. However, if you also adjusted their hourly wage down, so you not only cut their hours, but also adjusted their hourly wage, then the portion of decline not attributable to an FTE reduction would apply. So it won't ding you twice for keeping their salary or their wage the same, their hourly wage the same. If you reduce their hours, you will only you only have the FTE reduction. But if you both reduce their hours and their hourly wage, then both reductions would apply. It gave a little bit of guidance on how to apply for loan forgiveness. I say very little bit. It says the borrower must complete and submit loan forgiveness application, SBA Form 3508 or lender equivalent to its lender. And the lender has 60 days to issue a decision regarding loan forgiveness, which we've always known the 60-day rule has been out there. But what it also said is that once the lender has issued a decision, they pass that decision along to the SBA, and the SBA has 90 days to review and issue funds to the lender. And that includes review of the certification. So it appears based on this that, potentially the SBA could end up with 150 days to review if the lender takes the full 60 days to get that decision to the SBA. It also clarified that if the SBA determined the borrower was not eligible for the PPP loan, any remaining balance due must be repaid before the 2-year maturity of the loan. Last week, we weren't sure if the SBA determined you weren't eligible and required repayment, if that repayment was going to be required immediately, or if it would just flip to this 2-year loan. This interim guidance indicates that it flips to this 2-year loan instead. Could this change because of this 5-year loan payment that may be coming out in the new legislation potentially, but that's where we're at today. And then it also made it quite clear that the SBA could review a loan prior to application for loan forgiveness. Essentially, the SBA can review a loan at any time that it so chooses. With that being said, I'm going to go ahead and pass this over to Ben. He has sort of created a tool that helps our companies sort of capture all of the costs and track the amount of loan forgiveness. And he's going to go through that for you guys. We had promised you that last week. And so we're going to go ahead and give you an example of that now.
Thanks, Sarah. Share my screen here. Okay, so hopefully you guys can see that. So this is a worksheet, as Sarah mentioned, that we put together to help you in calculating your PPP loan forgiveness. In the questions on the right panel of your screen, we did respond to one individual's question on where this template can be found. So you can follow that link out, and on the right-hand page of the website page that it takes you to, you'll be able to find the download link for this spreadsheet to use on your own. I'm going to walk through just kind of a high level, really kind of how to approach this calculation, how to approach this spreadsheet, and what it's intended to accomplish, really. So if you look to start off with at the page as a whole, there's a number of tabs here. There's a number of calculations that go into this, and it's designed to really mirror the application that the SBA released a couple weeks ago. So these blue tabs that you see down at the bottom, those represent pretty much calculations that are lifted straight from the SBA forgiveness application. And the gray tabs are really tabs that we had to include to kind of support some additional calculations that you'll have to go through to come up with your final forgiveness amount. If you just start and work through this workbook from left to right, you should be able to kind of get to an answer based on what we know now. So there's no magic to which tab you start on. Just kind of walk through it tab by tab. So I'm just going to start here with our instructions and setup tab. So really, we just kind of walk through the overall layout and then give you guys a little bit of detail as to the format indications for data inputs in general. Anything that is in light blue is something that's looking for an input from you. Anything that's in white is a calculated field, and anything that is blue with a hash through it is you don't input right now, Sal, I'll say. So I've kind of pre-populated some data into the tool down in this setup screen, and this really is where you enter a few foundational pieces of information that'll be used throughout the rest of this book. So in our instance, we've got a borrower here that received $1 million in a PPP loan. The loan was funded on 4/25, and again, the blue cells you can input yourself. And then there's a couple other elections that we're making here that I'll go through. In general, the workbook is relatively dynamic, so this origination date that you select or input will kind of flow through to the rest of the workbook, and the date ranges for inputting things like covered costs will kind of be automatically updated. So some of the setup calculations or elections that we kind of select on the front end is whether or not we want to use the simplified FTE calculation. So the application provided a means to simplify how you count FTEs, that being if you have a part-time employee, you can count them as 1/2 employee versus some ratio of what they actually are, and full-time employees can be counted as 1 employee. So selecting this box true will essentially go through this workbook and update your specific inputs for hours worked by employees to either that 1/2 or 1 simplifying election. The second election here that will follow through to the rest of this workbook really is the FTE reduction safe harbor. So if you didn't lay off employees, you would check this box to be true, and it would kind of turn off some of the functionality and save you some data input on the back end. And then finally, to what we had discussed last week, there is an option for selecting an alternative payroll period, starting with the first date of your next weekly or biweekly pay run following the funding of your loan date. You can enter that information here, and then it will auto-populate the alternative payroll date throughout the rest of this book. Turning to these next couple pages, you might recognize this is pretty much lifted directly from the SBA loan forgiveness application, and it follows 99% of that same logic, with some small exceptions for taking into account things that we answered on the previous tab. But this is kind of the primary application where you can see the actual aggregation of all your costs and your payroll costs and your forgiveness amounts. And it will boil down to your actual loan forgiveness amount here. Again, this is pretty much straight off the SBA application. Schedule A is also from the SBA application, and this really is kind of a little bit more detailed aggregation of data that you input or will input on the succeeding tabs that I'll kind of walk through here over the next few minutes. And then moving on to kind of the last piece of the forgiveness application is the Schedule A, Table 1, Part 1. And this is kind of where the heavy lifting starts. So the application really kind of bifurcates your employee base into two components. One being employees that made less than $100,000 on an annualized basis in 2019, and those employees that made more than $100,000 on an annualized basis in 2019. And it has you enter those two populations on two different tables, those tables being Table 1 and Table 2 represented in the tabs in this book. This tab is where you will come in and enter essentially the wages that you paid your employees during the 8-week covered period or alternative covered period, and you will also enter in the hours worked. So again, the net result on this page is going to be what is the cash compensation to employees eligible for forgiveness, and what are the full-time equivalents for use in the calculation if you reduce your FTE headcount. I would start by just entering in an employee per row, and then kind of following again, starting at the left and working to the right of the worksheet, answering questions. And as you answer these questions, the blue cells will change shades from light blue, meaning you can input things there, to a shaded cell, meaning that you don't need to make any inputs based on your prior inputs in previous columns. So I think one of the keys to this tab really is kind of understanding the FTE reduction exception. So the SBA has said if you have an employee that quits or refuses to come back to work or volunteer, or you separate for cause, you're not penalized by those employees, and a reduction in headcount over the covered period. So selecting true for one of these employees in this column will essentially turn off the rest of the data inputs for that employee, so you don't have to spend time entering zeros for things that don't matter. And then what it does is it gives you an input to kind of look up the FTE equivalent of that employee during the reference period, which I'll get to in a couple minutes here. Next column is whether they're an employee is hourly or salary, because that will impact the way that you calculate the forgiveness limitations for a salary reduction. And then the last two columns here are, again, the cash compensation paid during the covered period. So in this case, it's April 30th to June 24th, which is driven by the original input of the date of the loan funding that I talked about on the instructions and setup tab. And then as you'll also input the hours for each employee to calculate an FTE. So this tab, it's Table 1, Part 2, is really Part 2 for Part 1. It starts by replicating the employee inputs that you made on the previous tab, and then walks through a series of questions in the form of columns that calculates the total forgiveness limitations that you would see from your employee base for salary reductions in salary. So it walks through a couple different safe harbors and really looks at Q1, for instance, and what a salaried employee made in Q1, takes 75% of that amount, and then says on an annualized basis, did you pay them essentially that equivalent over the 8-week covered period? If not, it calculates, in the instance of employee number 5 here, a reduction amount based on the percentage that you reduce their compensation below 75% of the amount at February 15th. And then again, this kind of centerpiece here really just walks through any safe harbor. So if you return your employees to full pay by June 30th, again, you would enter in their salary at June 30th or their hourly rate at June 30th, and that would essentially turn off the reduction completely because you would not be subject to it. So again, This section only needs to be considered an input if you made salary reductions to your employees. If you did not, then you don't have to worry about this input page. Moving on to table 2 of the application. This is for those employees that I spoke of earlier that made greater than $100,000 in 2019. For those employees, we're not really worried about the reduction in their salaries because according to the SBA, as it stands right now, that reduction just doesn't apply. What we are interested in is the number of hours that they worked, as well as the total cash compensation, which will be used in an FTE reduction calculation on Schedule A itself, and also obviously the payroll cost will be aggregated. These just all foot down. Right now, these spreadsheets are set up to support 25 employees, just so it doesn't look so overwhelming at first. But if you need more than 25 employees, we're happy to help you out and get a spreadsheet to you that will support your employee base. So moving on to something that is not in the calculation itself, but I think will help you guys, or I hope will help you guys. We prepared a worksheet where you can input the non-cash compensation payroll costs, so things like group health care, retirement, state unemployment insurance, those types of things that aren't run naturally or might not be run naturally with payroll. You could input those in here by week. The Table 1 and Table 2 tabs are really designed with a thought in mind that you'll be working with your payroll provider to run compensation reports and hour reports for the given 8-week period. So you can run those reports, use that as substantiation, and just drop in single numbers for employees. Whereas the non-compensation payroll costs and the non-payroll cost itself, you'll probably be aggregating as you go over the 8-week period. So we kind of provided some space for you to start accumulating this information as you can. And then you could even put in actuals as each week passes and estimates through the end of the 8-week period to kind of track how you're doing and how much forgiveness you might qualify for. These dates again will change based on your inputs for the loan origination date, whether you're using the covered period or the alternative covered period for non-cash compensation costs. And as we move down to non-payroll costs, those are your mortgage interest paid, rent or lease on real and personal property, and your utilities. Those stick with just the strict 8-week covered period. So those dates will also populate accordingly. So the second to last tab is really supporting our calculation for reduction in FTEs. So you would select your reference period, and again, you can use either the effectively 6-month period from February 15th through June 30th of 2019 as your reference period, the 2-month period for the first 2 months of 2020, or if you're a seasonal employee, you can there's functionality for you as well where you can pick your seasonal period start and end. That must be between May 1st and September 15th. But here you would go in and enter by employee the hours that they worked in the reference period that you selected, so that way you can calculate what your baseline FTEs are for your reference period, or that denominator in the equation that is your FTEs during the covered period over your FTEs during the reference period applied to your actual loan amount to figure out what your forgiveness is. And if you recall back on Schedule 1, we had an employee that we selected true, meaning they either voluntarily left, or they were fired for cause, or they refused to come back to work. We entered a number here. That number correlates to the employee number on our reference period tab, which will essentially look up what his FTE equivalent is and include that number in your final forgiveness calculation. So that way you're not penalized for those folks that qualify for that FTE reduction exception. Finally, we've got a PPP owner compensation support tab. So as you might have noticed, there was no spot to enter owner compensation along the way. And one of the things that became clear when the SBA released the forgiveness application is that owners are really kind of in a pool of their own. So they're really not taken into consideration when you're calculating the FTE equivalents, at least as the application stands now. So here is a space where you can enter in your compensation by owner to be included in potential forgiveness. This is again limited to the consistent $15,385 for the 8-week period. It's the lesser of that, or the essentially average owner compensation over the average 8-week period in 2019. So you can't pay yourself more than you did in 2019. So all of these data input tabs that I just walked through here really work to support and are summarized on this PPP Schedule A tab and the PPP Loan Forgiveness tab. So the Schedule A aggregates all of those costs, being payroll costs, direct compensation and non-direct compensation, as well as non-payroll costs. And here's where your FTEs are calculated and aggregated. And it's kind of the basis for all of your calculations to understand forgiveness. These are then summarized, and the actual calculation is walked through on the primary loan forgiveness application page here. So you can kind of see the amounts that were entered in this sample are kind of collected, and the same logic is followed as on the PPP loan forgiveness application to boil down to, in this case, a $63,684 forgiveness amount. So again, this is kind of available on our website. It is, based on everything that we understand to be now, and will probably change. It's already changed since the first time we released a forgiveness application, based on the release of the SBA forgiveness application itself, and I'm sure it will change a few times here over the next few weeks as additional IFRs are released. But for now, this is kind of as we understand it to be the calculation that's intended. So, Tim or Sarah, are there any questions specifically related to this? Or
yeah. But could you go through that one more time?
Yeah, I'm gonna get right on that.
No. I mean, to me, what's clear is that I think as our participants ask questions or they get through this, hopefully they'll provide us some feedback on, all the information you provided there. The one thing is clear is, and we talked about this before, Ben's entrenched in this spreadsheet and this process, not only in helping us develop a tool for our clients, but also implementing it with some clients. So, his familiarity with it and ease with it, hopefully will lead to the participants being able to use this equally as easy. But I suspect we'll have some questions as they go through it. We have about 12 minutes. So, Sarah, I don't know if you were taking the reins back, or if you wanted to maybe bring up some of the questions that have been addressed or not addressed yet within the queue here.
Yeah, I mean, I think we can just start going through some of these questions. I saw several questions that asked about, when you're determining whether or not you're an employee owner, does it matter how much percentage you own? And there is nothing anywhere in any of the guidance or legislation that puts, ownership at a minimum threshold for making these determinations. It seems as though any owner, whether you own 1% or 100%, would be considered an employee owner. Tim, I don't know if you agree.
I absolutely agree. And it's funny, we have so many rules for determining ownership within tax legislation between related parties, the 2% shareholders for fringe benefits, and in this case we have nothing. So the presumption would be to err on any owner. Any owner falls into this bucket, and certainly for a self-employed, that's really black and white. And of course, they face the harshest restrictions in not being able to consider their health care or their retirement benefits in their calculation for forgiveness.
Yeah, I mean, and I will say, you bring up a good point, Tim. I think Tim and I sort of disagree as to who is impacted by this health insurance and retirement contributions. I sort of read the rules and think that any owner, employee owner, does not get to count their employer contributions or the health insurance premiums that they pay for those people. Tim thinks that we can. I don't know what the actual answer is, but the way they wrote the rules, it's a little bit unclear, I guess.
Yeah, and so what we're describing, everybody, is the $100,000 cap, which equates to $15,385. The presumption has been typically that that's the wage, the compensation limiter, but then you would still have health insurance and pension contributions that would still be eligible to go beyond that if you looked at how much benefit did a particular employee get. Well, the 14th IFR that came out on loan forgiveness has kind of a sentence in there that I'll call it a compound sentence, where it brings in the contribution for healthcare and the contribution for pensions to owners. And what I'll say is I think Sarah and I are going to circle back, because I went back and read the act, the law, and the term compensation is used as a specific line item within payroll costs. And so that's why I'm going to lean towards, I believe the answer is that the limiter at $15,385 is for wages only, and that compensation, benefits paid to owners for healthcare and pension are not limited, other than for self-employeds who have to look and see what did they do in the prior year. Same thing with partners. For our S Corps and C Corp owners who take wages, they don't have that prior year limiter. But what we'll do is, let's do this. You and I will circle back on this, and we'll make it a part of our absolutely next Wednesday's discussion, but maybe even sooner if we can edit our Q&As on this. But I do want to make sure, hey, we're human. We read this stuff. It's only been out a few days, and our objective is to give you candidly the best information you can. And sometimes two great minds, and I mean really great minds, can differ. Ben had no input on this whatsoever, so.
I think that Ben is in my camp, by the way.
I did overhear Ben in his discussion on the spreadsheet, and we'll deal with the flaws in the spreadsheet later. It's great that nobody's within arm's length of me. Nobody can slap me from here.
No,
you know.
I mean, I will say, Tim, I agreed with you originally until the loan application came out, and then once the loan application came out, it seemed to exclude all employee owners from this. And that's where I sort of came to that conclusion. And the interim final rule didn't change that conclusion for me. So we may be at next week and still not agree with how we view that. It may end up that if we get this extension, it won't matter, because I think right now a lot of our clients are having some difficulty getting 100% forgiveness because they can't spend all of the money in the 8-week period. Their payroll costs aren't high enough, and their rent costs aren't high enough to get there. This 24 weeks, or even if it's only 16-week extended period, it's the way the legislation is written today, which is sincerely subject to change. Obviously, it hasn't been passed into law, but the way it's written today is it extends the entire covered period. So today your covered period is 8 weeks. It extends that to either 16 weeks or 24 weeks, which gives you 16 weeks to spend the money. So these things may not be as impactful if we get that extension, because for those of you who are already up and running and have hired people back and have opened your doors, you're probably incurring payroll costs, and you'll have no problem. Even if owners were completely excluded, you would have no problem reaching that full forgiveness. So I think that this extension will really allow most companies to get full forgiveness, unless you have compensation reductions still in effect at the end of this new covered period. I think this carve out for the FTE reduction, if you can demonstrate your business has the inability to be back up to operations at the same capacity as it was on February 15th, is pretty friendly for a lot of businesses. So you may be in a position where you had FTE reductions and you can't rehire those employees because your business just doesn't warrant that rehiring, and you may still be okay if, again, this legislation gets passed. I thought it was pretty telling. I read the proposed legislation on Friday, on the 22nd, and it changed yesterday. And it added some of these friendly rules into place to bring it more in line with what was proposed in the Senate before they broke for recess. So it seems as though both parties are in agreement with what they want. They're a little bit disagreeing on the timeline, and I don't think that that's going to be a big hurdle to overcome. It doesn't seem like anybody thinks that's a big hurdle to overcome. And the big sticking point in the Senate, the reason why that bill didn't get passed before they left for recess was because there were some senators that wanted to attach other legislation to this bill. So the House bill is much cleaner. We'll see where it ends up.
Okay. We got about 4 minutes. I see I'm going in the order. I just looked at a few seconds ago. Scott asked a question about owners who didn't take compensation in 2019 and now take compensation in 2020. And I think it kind of goes to, I'm going to circle back to something we described. There's a different answer if you're a partner and you're a self-employed person versus if you're an employee of a corporation. And there is not a limiter for a corporate employee, for a salaried employee who did not take wages in 2019. The limiter is for, now I'm looking at your tilt your head, you're going to tell me I'm wrong, but
I disagree. Yeah.
All right.
I think Ben is with me because we've talked about it.
Yeah.
We're gonna gang up on you now, Tim.
I'm gonna make you show me. I'm gonna make you show me the law.
I will show you. It's in the application. This term employee owner is what's throwing me. It does in the application. It says employee owner, and in parentheses it says something like for a corporation as well.
So, but what you're saying is in that category, they're putting that bucket in the limiter of what did you make in the prior year. Okay. Yeah. That is not how the law states it. So the interim final rule now has a disagreement. And yes. So having had this beat in my head during my master's in tax, what you learn is, and what you teach every new accountant who comes into a CPA firm is, instructions are not laws. And so the instructions, we'll see, maybe we'll have a change, but it's good that people understand that could be a significant difference. And we got another question here on owner's son works for us. Yeah.
Before you move on real quick, I do want to also say is what has not been issued any guidance is for those businesses that started sometime in the middle of 2019. It was clear that they were eligible to participate in this program. And so far, there's been no guidance on how they would be able to be eligible for forgiveness, which seems contrary to the intent of the law. It seems as though the law was written so that those types of businesses were also able to take advantage of loan forgiveness. But so far, we've gotten no guidance. So for those of you who started a new company in mid-2019 or towards the end of 2019, and maybe weren't able to pay yourselves, or maybe you didn't make a profit, we don't know how your loan forgiveness is going to be calculated.
Yeah. Well, I'm going to say to Mr. Liu, Grace, we'll get to some of their questions here, maybe in our post-closing discussions or post-closing answering questions that I described before. So we're at 3:59, everybody. As we promised, we'll be done at 4 o'clock. We're going to ask you to continue to save the date for next Wednesday. You can hear even with Sarah and Ben and myself, although it sounds like it's Ben and Sarah versus Tim on a few of these. And I will admit when I'm wrong, but there will be balloons around me if I'm right. To be clear, there will be definite balloons around my head. But we'll continue to keep plugging away and get the right answers. This is important to our clients and important to us to be able to understand this and convey this value to all of you as well. So look forward to seeing you next Wednesday at 3 o'clock. Please look for follow-up correspondence on the presentation. So you'll be able to see this after the fact, and you should be able to see the links to Ben's resources as far as assisting with the calculation for those. And there may be people out there who haven't filled out the loan application yet. So both those resources are available to help you with this. That being said, you'll probably, you might see us, you might not, but we'll be continuing to answer questions. So for those of you who are still online, which is a few hundred still, we'll continue to answer these questions. And if you're interested, you can still continue to type questions. But at some point, Sarah has to go to bed. So. Yeah.
Or get
So
to my
we're gonna,
wine.
yeah, we're gonna ask Brian to go ahead and cut us off, and perhaps even cut our mics so that nothing unforeseen occurs.
Thanks, guys.
Thanks, everybody. Thanks, Ben. Thanks, Sarah.